Welcome to NYPA's Homeownership video series, developed to provide information and educational opportunities to our current and future homeowners in recognition of National Homeownership Month. NYPA provides educational opportunities throughout the year in many formats. This year, we have adapted to our new social distancing guidelines and created this video series. We have many great sponsors and exhibitors that partner with us for our events, and we want to say thank you to MGIC and Westgate Bank for sponsoring this video and being great partners. Today we have Stacy Fatinos with NYPA, as well as Jackie Young with NYPA, and they are going to lead the discussion today and introduce your speaker. Thanks, ladies.
Thanks, Amanda. Hi, everyone. My name is Jackie Young, and I am the Chief Homeownership Officer at NYPA. Thanks for joining our webinar today on the benefits of MI. MI stands for mortgage insurance. I'm pleased to introduce Danielle Swerczek, who is the Senior Account Manager at MGIC. MGIC is one of our important partners who help make homeownership affordable with low down payments and reduced mortgage insurance premiums. Danielle is going to talk about some of the benefits of MI with a focus on how and when homeowners can cancel MI with a conventional loan. When she is done with her presentation, I will follow up with a few questions. Take it away, Danielle.
Thanks, ladies. Well, it's a great honor to be here today. And of course, we love partnering with NYPA. And so huge shout out to NYPA for inviting me to take part in this webinar. And welcome to all of those that are watching the webinar today. I hope that you gain some insight through all of this and that you're able to get some questions answered. And if not, we have some resources for you that we'll share at the end that you can take advantage of on your own. So let's start with the benefits of mortgage insurance. And as Jackie mentioned, I am Danielle Swerczek. I am with MGIC, and we are a provider of mortgage insurance, which allows homeowners to take part in buying a property with less than 20% down, actually with as little as 3% down. So it's a great program, and I'm just here to talk to you about some of the benefits of mortgage insurance and then the versatility of being able to cancel mortgage insurance when you reach that schedule on your loan. So let's go ahead and get started. And before we do, I do need to just quickly do our legal statement, which just basically says that I'm going to present information today, and some of it is a reflection of MGIC, and some of it might just be my own personal views and opinions, and therefore you hold both of us without any liability with our statements. So, okay, so let's go ahead and get started now that we have that out of the way. So let's talk about the benefits of private mortgage insurance. So kudos to all of you for getting into your first home. It's a big milestone. It's the American dream, as we call it. And with mortgage insurance, it allows you to do that if you don't have 20% to put down. It increases your buying power. It expands your cash flow options. We're actually seeing a trend of people wanting to put less than 20% down because mortgage insurance has become so affordable that allows them to keep their cash for new furniture, for that new lawnmower, those maybe appliances that you want to replace in your new home. And this will allow you to have a very a small monthly payment with mortgage insurance to buy those new things for your new home. It's also less debt and more equity than FHA. It's great for most borrowers, and there's the ability to cancel the mortgage insurance when it's no longer needed, which is a great benefit to mortgage insurance. So let's talk briefly about how mortgage insurance is paid for. There's two options, and the most common option that we see is a monthly payment, which is what you're probably most familiar with. And if you're watching this video, that's probably how you're paying your mortgage insurance. There are some options for single premiums, and those are always worth looking at for borrowers with high credit scores, low loan to value. Those are always great options too, depending on the scenario of the borrower and what their goals are in the home ownership. we can talk a little bit about monthly premiums. So I'll go through that very briefly. So with monthly premiums, you don't pay anything up front other than if you pay your first monthly due at closing. It's paid with your monthly mortgage insurance. Chances are you're not even aware that you're making that payment because it's just all part of the process and your payment that you make to the bank. And if you do ACH, then the money just gets automatically taken out of your account. The thing with monthly mortgage insurance is it is able to be canceled. And that's the beauty of the monthly mortgage insurance. When you reach the 80% on your loan, then you're able to request that cancellation from your servicer. And we'll get into those details in a little bit more. The other thing with monthly mortgage insurance is it just gives you some versatility. And that's a wonderful thing to be able to have when you're talking about a product such as insurance. Next, we can talk about single premiums. And the single premiums are a little different in that you actually pay that premium up front. And so what that means is you pay that lump sum up front, and it's calculated just off the ratios and everything that we discussed earlier, your FICO score. And what you do is you just pay that right up front, and then you never have a payment again. Now, the disadvantage of doing a single premium is if you go to refinance that loan a little later on, you may not have a refund coming back to you with that upfront premium that you paid. So it doesn't give you as much versatility, but it's certainly an option, again, depending on the goals that you have as a customer. If we could go ahead and advance slides to how do borrowers cancel MI? So let's talk about how do borrowers cancel mortgage insurance, which is what we really wanted to educate you on today. Sometimes people don't even think about canceling their mortgage insurance because, like I said, it just becomes part of your payment. And so I just wanted to give you a little heads up on how that might actually work and what your options are if you are doing monthly mortgage insurance. So monthly mortgage insurance will automatically terminate from your lender, which is who you pay your payments to every single month, at 78%. And the reason it's at 78% is because it just takes time to process that through the system. And that's based on your amortization schedule that you receive at closing. So that amortization schedule that looks a little depressing with all the numbers that run all the way down to zero after 30 years, if you look at that, you will see where your payment's going to change and when exactly it's going to change based on when you reach the 78%. Now, you say, well, I always hear 80%, which is so very true. So let's talk about that. So if you feel that you have reached the 80%, or you know you have reached the 80%, then you just simply reach out to your lender, again, or your servicer, whoever you're making that payment to, and you can actually request that MI to be canceled and taken off the loan. Now, there are some general rules to that, meaning you can't have any late payments, you have to be paid up to date, just those simple common sense things that you would think about. So just be aware of those things. And the lender may have a couple other requirements, but again, if you get to that point, simply make a phone call to your lender, let them know that you're interested in doing that, and they're probably going to ask for a couple things, and that's okay. At least you'll know ahead of time. Okay, so let's talk about current value. So some lenders might require that you have the mortgage insurance on the loan for 2 years. Typically, that's what we see in a lot of lenders, is they require it to be on the loan for 2 years. Again, a simple phone call to your lender if you think that you're at the 80%, just so you know those guidelines ahead of time. And again, like we talked about, acceptable payment history, and then chances are they're probably going to want an appraisal on the property. But again, not much money to get a new appraisal, depending on where you are geographically, and then you'll know what that's like up front. The last thing I want to talk about today is we have a website that's specifically for first-time home buyers or move-up home buyers. And it's a really great resource. It's called readynest.com. And the reason I love this website is because it's very easy to get overwhelmed with the home buying process. There's tons of information out there, a lot of details on certain websites, and some of it, quite frankly, just might be a little overwhelming. So MGIC has made a website specifically for first-time home buyers or move-up home buyers, and there's tons of information out there. I highly encourage you to visit it. Even if you already have your home, there's budget worksheets you can print off, there's decorating ideas, what to do if you're getting a new puppy during this quarantine, which tons of people are. I just encourage you to go kind of click around. There's a glossary of terms out there. There's mortgage calculators. If you think you want to do something different a couple years down the road, what would that look like? How much will you have to save? Feel free to click around in there and just have fun with it, because it's a great website. I even get in there. ReadyNest.com, and it's brought to you by MGIC, and we are a mortgage insurance provider. And we're happy that you're here, and I'm happy that you have your home. And congratulations to you for taking on the mortgage insurance so that you can get your first home. Thank you.
Thanks for the great information, Danielle. I think one of the biggest questions homeowners have is, will MI always be required with my mortgage loan? So I do have a couple questions for you here. The first question, what is the process to cancel mortgage insurance?
Sure, great question, and certainly one that, you know, a lot of people think about after they get into their loan. You know, sometimes people want to get that mortgage insurance off as quickly as it went on there, and then others find out, you know, that maybe it's not so bad having the payment, because again, it goes back to the flexibility of having their cash, which is important. The process to do that is making a phone call to your servicer, or when we say servicer, we mean the lender that you're actually making your payments to every month, and just ask them what the process is to get that off of the loan. Typically, we see lenders require 2 years, seasoning requirement, and then most of the time they will require an appraisal. But again, it's just a conversation with the lender so that you are have that information ahead of time.
So you mentioned the possibility of an appraisal. Are there any other fees required to cancel mortgage insurance?
There could be some fees. Typically, lenders do require the appraisal to be done. And when we're talking about appraisal, again, like I mentioned earlier, it could depend on geographically where you're located. And that typically could run anywhere from $400 to $800 for an appraisal. And like I said, depending where you are in your loan and your amortization schedule, it could be worth spending that money to get the mortgage insurance off your loan.
So how will I know when I reach 80% equity on my mortgage loan?
Sure. So a good guide to use is the amortization schedule that I mentioned earlier. And typically that is the long sheet of paper with many, many pages on it if you got a 30-year loan. And it goes through every single payment, and it shows you what goes to principal, what goes to interest, what your running total is. And that's a good guide to look at so that you know when you're getting close. And if you want to get that off, I would definitely start with that. You could also call your lender and ask them what it looks like for you to see when you're getting close on that, you know, 20% equity in there. Sometimes if you're in an area that appreciates quite quickly, you could actually reach that, you know, within several years. And again, it's just something you want to monitor with maybe other houses in the area, what they're selling for compared to your house and what that looks like. So I just encourage people to make a phone call about it.
All right, and then the last question that I have for you is, sometimes it's confusing with different loan products. So can you explain why some loans require MI, why some loans do not require MI, and why some keep MI for the life of the loan?
Sure. So that goes back to, you know, with the 20%, if you don't have the 20% equity, which many homeowners don't have the 20% equity, especially first-time home buyers. I mean, even move-up home buyers don't have 20% equity. So with private mortgage insurance, that just allows you the opportunity to get into a house sooner and allows you to put less down so you can keep your cash. Now, when it comes to loans without mortgage insurance, those are homes that, you know, probably have 20% equity and therefore they don't need the mortgage insurance on their property, which is a wonderful thing. But typically that we don't see that with first-time home buyers. And then you do have loans that have mortgage insurance that's on for the life of the loan, and you don't have the flexibility to cancel that. And those are typically FHA loans that we see. So again, great product. It's certainly valuable for some borrowers out there. The only thing is you just don't get the flexibility to cancel the mortgage insurance, and you have to pay that upfront, a fee upfront plus a monthly premium on those. Different products, all great. I mean, if it allows people to get into their first home, and you know, that's a wonderful thing, right? That's the American dream that we're trying to, our goal.
All right, very good conversation. Stacy, did you have any other questions for Danielle?
I actually do have a question for Danielle. When you were talking about the difference between single premiums and monthly pay premiums, how can you weigh which one might be the better option for you?
Sure, great question. There's actually resources out there, and your loan officer, your lender who you're working with can actually price both. There's some pricing systems that they have access to, and I think it's always good to look at both, just as a general rule, because with risk-based pricing on the insurance side of things, it's much like car insurance, homeowners insurance. There's different factors that go into mortgage insurance. I always encourage loan officers to look at both options. That way you know what it looks like. And the single premium might be, you know, an amount that's not possible for people up front, and that's okay, but at least you know by looking at it.
Thank you.
Mm-hmm.
Okay, Amanda, I think we're ready to turn it back over to you for some final comments.
All right. Well, great conversation, ladies. This is a perfect topic to cover in our series for this month. But I just wanted to wish everybody that's tuned in for this video a happy homeownership month. And we encourage you to check out all of our videos that we'll be posting out on our Facebook page. There's chances to win some awesome prizes out there. You can see how to enter and what the rules are on our Facebook page. It's just NYFA Housing. New videos will be published every Friday in June. And thanks again, ladies, for tuning in today. We really appreciate you joining. So,
Thank you.
have a great day, everyone. Thank you.
Bye.